Hello and welcome to episode 161 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leeds. Damien, welcome back. How are you doing?
I'm good, Andy. I'm really good actually. I've had an interesting week, a lot of work being done behind the scenes, and some really good positive feedback we've had from the listeners, which is always nice to have, because we also had this week, you always get the opposite. You get the good, the bad, the yin, the yang. When you do what we do, you always get people in the industry trying to have a pop at you because of jealousy. They don't like the fact you help people for free. But there you go. I don't really care. I have broad shoulders. But I just want to mention on that, to say a big thank you to Jeff. I won't say his surname, he might not want me to, who sent me what can only be described as a War and Peace style email, which was quite incredible. About he'd listened to our podcast about at the end of last year, which talked about what Money to the Masses had done and where we were going, and he was inspired to give feedback about what we do and how much he enjoys it and it helps, but also about where he thinks we could go as an entity, and what in terms of helping people because of the trust that we build up. And he would love us to be able to venture into areas that can be even more direct in terms of the help they give. So when I'm saying that, I'm being a bit sort of evasive, but it means like people like me helping people directly with their finances. So that was quite timely. It was a really good boost to receive that. So I thank him for it, because those sorts of emails, people don't realise, we read them, we digest them, and like anybody who runs a business or a website or corporation, they should take on board the feedback people give, and especially when it comes from somebody's own thought and creativity of saying, look, I think you could go down this route. As a consumer, I think this would be amazing if you could do X, Y, and Z. So I thank Jeff for that. And if anybody else out there has any views or wants to give any feedback, constructive or otherwise, then feel free to send it in to me at the usual email address, which is damien@moneytothemasses.com, or you can obviously ping me on Twitter, but you're pretty restricted what you can say there, at Money to the Masses with the number 2. So yeah, I rattled off into that, Andy, but that was really my week. I've been also heavy into 80/20 investor this week. But what about you before we move on?
Well, me pretty much the same in terms of, feeling energised and getting lots of things done, and kind of like that really, both inside my sort of personal life and also at work. I'm feeling really energised. And do you know what, Damien? I even got to clear out my garage last week, which has been doing my head in for months. So I feel great.
That is a positive, clearing out the garage. But
and that's not a euphemism.
Right. So
right, what are we doing money wise this week? Let's move on from that. Let's not even digest what I just said there. What have we got coming up
on the podcast this week? We've got 3 pieces really. The first piece is one that really trying to give. It's got a slight investment end to it that I want to be just slightly positive. It's just a positive message, because I'm getting a bit bogged down with the negative messages that are in the media at the moment, and I'll come on to that and you'll understand what I mean. The other one is a piece on investing and really the investment outlook for 2018. Now this is the sort of thing that anybody who's vaguely into investing would love to know, what some of the potential outcomes or things to watch for in 2018 are. And I don't know how that piece will evolve. It could be longer than I anticipate. And if it's not, and I can squeeze it in, then I will talk about some ways to boost your pension in 2018. So we've got to see how we get on. But if it doesn't get into this podcast, it will be into next week. So shall we rattle on, Andy? Shall we crack on?
Let's do it. I'm energised. What have we got first?
Right, let me just talk about this first thing that rather quickly. Now, I'm a bit fed up of some of the national press coverage. Now, I know I do appear in the national press stuff for money things, but there have been a lot of topics that have been based around negativity, negative emotions. So, for example, already we're only about a week into the new year. We've had Divorce Day, which is the typical day or the peak at which people become divorced or apply for a divorce following the new year for various reasons, which tend to be a build-up of probably Christmas frustrations and family meetings and gatherings. It seems to bubble up, and somebody has worked out that that was the peak day for getting divorced, which isn't a particularly positive message, but it was all over the press, so that's a bit of a negative. There was also the day of, in this same week, I mean, blimey, I'm surprised anybody gets out of bed. There was a day where the fat cats officially have earned more than their lower paid employees would do for the entire year. So in the first few days of this new year, the fat cats out there, the CEOs had on average earned more already than their employees would in an entire year, which is also another negative one. And there was also Blue Monday, which I think Blue Monday was the Monday just gone, which is kind of a variation of all the others and bundled up. It's basically the most depressing day of the year for various reasons, including the weather. I don't know what that's got to do with money, but people failing on their resolutions, motivation levels, and actually the key one is the ability to pay back the money they owe, largely because of spending at Christmas. So there's a financial angle to it. So I just want to go out there and on a limb, and if you're feeling a bit fed up, then we talked about how to keep resolutions last week, but two quick things before we move on. There's the 30-Day Money Plan is the book I wrote probably about 5+ years ago, and I've just updated it. So if you get the book you download for free if you go to the moneytothemasses.com/podcast webpage, you will find a link to be able to download the book for free. Now, the book itself hasn't changed, but there is a link in the introduction to be able to sign up for updates. And I update the pages in there, so the links, if anything's broken or if anything's changed. So read the book, sign up for the email, and you'll get the email. And you can look at the two in conjunction to see if anything's changed. So that was the idea of that, was there were lots of simple things you could do in less than 5 minutes a day to improve your finances over 30 days, covering everything from mortgages to bills, etc. So that is something positive to do. And of course, if you're feeling a little bit down and depressed, then the One Giant Leap podcast that we did last year, which will come back, I know I keep saying it, but it will come back, which I interviewed people who've done some amazing things, who were feeling a bit down, like anybody listening to this podcast might be doing their side hustle. Not as a result of this podcast, I might add, feeling down, but just being down generally. Have a listen. But the final thing I want to add to this piece before we move on is a slight piece of good news. It's an investment slant. Now, some time ago on 80/20 Investor, I think it was about 2 years ago, I did a piece of research that identified the most profitable day of the year to invest. Now, if you're listening to this, you're thinking, how can one day be profitable? What I did is I went back and analysed every trading day on the FTSE 100, which was at that point was over 8,000 trading days. And I looked at every trading day and thought, if you started investing on a particular day going back to 1983, I think is when the FTSE 100 started, and then invested for 5 years exactly and cashed out, what would happen? What would be the best day to invest? If you think of all the possible 5-year periods there could have been, you can imagine there's a lot. And so I looked and pulled them all together and said, well, is there a period where in starting to invest for a period of time for at least 5 years or more, then that tends to be a good time to get in. Now, the good news was, I feel comfortable telling people this because 80/20 investors have had this information for 2 years now. The peak days are actually in Q1. They're actually in January to March. And I think that's partly because of the uptick in interest for investing due to the tax year end and people being more engaged with money in the new year. But the peak day actually turned out to be the 10th of January of any year. So we've just had that, I think. I think that was, by the time I'm recording this, a day or two ago. So this period of time is actually very good for investing. It's not guaranteeing you will make money because, of course, there were periods where if you invested on those days, you might have lost money when you eventually came out in the market. But as a piece of quantitative research, it's very interesting and no one had ever done it. So I'm just giving you a positive message. The press are telling you that you should be down in the dumps and everything's bad when it comes to money and relationships. But if you want to get into investing, then current conditions notwithstanding and aside, just generally speaking, it's never been a better time in terms of date-wise to invest. There you go, Andy.
That's a really timely bit of information and a lovely bit of insight. And if you like that bit of insight about what Damien does there, digging down into the detail and providing valuable information for you to sort of empower you to make your own decisions in terms of investing, then really you should think about the 80/20 service that Damien provides. You get a free trial and there's absolutely no pressure to carry on that payment. Give it a go. Read some of the stuff that Damien writes. That is the key bit of information that you need. And actually, talking of that, let's play a little advert and we'll see you on the other side.
Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers, and the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
And keeping in with the investment theme, Damien, you wanted to talk about sort of an investment outlook. What are we talking about?
Right. This is something that is probably very relevant to this period of time. I know we try and keep things evergreen, but it's always nice to talk about something that is the investment outlook for a period of time, because people are worried, okay, Andy, that markets are at all-time highs. Does that mean we're going to have a correction? If it does, what are the likely triggers for that? Basically, everybody is trying to second guess what's going to happen. And this crystal ball gazing idea is obviously the route to madness, but I wanted to give people a view of some of the things to look out for in 2018 when it comes to investing, because it's useful and it's to give them some value and some insight. Now, if you want to know more about this stuff, again, I do it more in 80/20 Investor, but let's just talk about one thing. People ask about predictions. Where are we going to end up at the end of 2018 versus where we were at the end of 2017? Now, 2017 was a very positive year. It was one of the best years. It's as good as it gets in terms of investing. The markets were up double digits. Pretty much every asset you could have possibly invested in, I think nearly every asset, went up. And even though it was to varying degrees, it was a year that was good to be in the market, despite the fact at the start of 2017, people were still panicking about the prospect of markets crashing. Now, to give people a bit of insight, I won't make predictions of where the market will end at 2018, but investment banks out there like to make predictions of where markets will end at the end of 2018, because in a way that's kind of what they're paid to do, because they invest people's money. Now, as a general average, they are becoming increasingly bullish, despite markets being at all-time highs, about where 2018 will end up for various different assets. And generally, they think it's going to be a pretty good year for stock markets, for example. Now, one thing I would say to people before they run off and go yee-haw and start putting all their money in the stock market, bear in mind who tells you any message that you hear. Investment banks will generally, I would argue, be more bullish. Let's be honest, if you make money from investing people's money,
Yeah.
then you're not going to say to people, run for the hills.
Don't invest.
Don't invest. Go to cash. Cash is king. If you put money in it, you're nuts. That wouldn't go down very well with their clients. So they make money out of investing people's money and skimming something off the top. So they are always going to have a slightly more bullish outlook, I would argue. So I have to think that the people's expectations need to be a little bit more realistic. That if last year was the exception to a rule, then this year, I think if you go in with your eyes open, then yeah, there's a possibility of some form of correction. But we said that for all of last year, and the fact is we just don't know. So those who are crystal ball gazing out there don't necessarily pay too much attention to it. There is something called confirmation bias, which means that you do tend to gravitate towards things that confirm your existing ideas or what you want the world to be like. And that is something that's human nature. We do it all the time. So you've got to try and find the opposite view to what you think. If you think the market's going to go up, you should be reading things also to give you balance about why the market could go down. Now, on that, I want to just talk about a couple of things for people to really keep an eye on in the market, where things could go wrong. Now, we have geopolitics, which is the term that's widely used for anything that is a potential minefield in the political world, somewhere in the world. So a good example is Donald Trump trying to cause a nuclear war with North Korea. That would be geopolitics. Those sorts of things are always going to be cropping up and popping up. And you never really know where any of these things are going to come from. We know some of them that might be out there that we're keeping an eye on, but sometimes it's the things you don't expect that suddenly pop out of the ether. And there are some elections that are going on in Europe. I think there's the Italian election this year. There are the midterms in America. These are issues that will come to the fore at some point. Now, one of the trends of last year was that the volatility in markets was extremely low. It just kept going down, kept dropping, and it hit or went near historic lows. Now, one of the things is, if you ever hear of something called the VIX, VIX, not the stuff you put on your chest to get when you've got a cold, but the VIX is a measure of volatility in the American stock market. Just think of it as the fear gauge of the market. If you go and Google it, you'll find it. It's a number, and it is a measure that shows how nervy people are. That's what it's generally used as, even though that's not the official reason it exists, but people look at it. And it's down below towards 9 of 10. And that is a sort of showing that markets are very calm, or you could say complacent. The average is up near 20. So when something goes wrong or people get a bit worried, it jumps. And so that's something to keep an eye on if you're wondering if the market is getting nervy, because previous stock market crashes have always been, not always, but they generally are preceded by a pickup in that level of nervousness in the markets. And so for an average investor that sits in his armchair, it's quite hard to have a measure, like a dipstick of what's going on in terms of fear. So have a look at that. And one of the other things, I'm not going to talk about all of the various things to look at. One of them I will mention is technology stocks. Now, technology stocks drove the market up in 2017, and they're called the FANGs. And that is the acronym, which in investing, they always come up with acronyms. So we had the BRICS. Do you remember? It was to do with the Brazil, Russia, India, China. They were the countries that were meant to be the lead in the emerging market rally years ago. So they bring it together. It kind of makes it easy to understand. It makes very good news headlines. The FANGs are Facebook. You've got to remember them all now. Amazon, Netflix, Google, although that's called Alphabet now. So you've got these names. They create an acronym of them, and they have been they were the stocks that took drove the market up last year. They rallied incredibly strongly. So if you're an investor, it's always worth looking at the share prices of those stocks, which you can find quite easy to see what's going on. Because one of the reasons we did a podcast, go back about 3 episodes ago, where we talked about the tech rally and what you can learn from that. So I'm not going to go on about it too much here. But one of the things it can show is whether there's been a change in the trends that are driving markets if they start to flag. Now, it leads on to this idea of inflation as well that comes into the market. Now, the market has been betting there will be no inflation coming through, and one of the things that we would hope to see at some point is some inflation coming through. Otherwise, it's a sign that the economy is probably not doing very well, or not going to do very well. And it also led into one of the reasons why the lack of inflation, as to why stocks in tech firms were doing quite well. And it was down to the fact that interest rates didn't look like they were going up. And if interest rates go up, then it means that the earnings of tech stocks, which are way off in the future, when you discount them back, don't look as good. So that's why. You go back to the previous podcast and I'll explain it in full. Now, one of the big things I want to talk about leads on from inflation, and inflation is bad for bonds. Now, that is because, again, for the interest rate reason. If inflation picks up, it means interest rates will be increased by the central banks to counter inflation. And it also means, therefore, bonds, which are effectively loans, that's what they are, even if you don't realise that, where you pay an amount of money and then you get a fixed rate of return. That fixed rate of return doesn't look very good if interest rates generally are going up. Just think of it, this isn't correct way of thinking of it, but think of it like being in a really naff bank account. When you see other interest rates going up, you'll start thinking, well, that's not great, is it? So, in bonds don't do very well. And what we've got is a world where bonds are facing quite big headwinds. And in the last since the financial crisis, what's happened is central banks printed loads of money to stop the world collapsing. And what it did is it drove up stock markets. But the way they printed money wasn't necessarily to print money and flood it out there, actual paper money. What they did is make electronic money just make it out of thin air, and then they bought things like government bonds off of banks, and then therefore the money those banks had was meant to go into the wider economy and oil the wheels. Well, what it meant, therefore, is that there was some huge buyers of bonds and things like that in the market, and we're talking trillions of dollars and pounds worth around the world. So there's some big buyers in the market that therefore distorted that market, which is why we had yields go so low, and it's why we've had things like the VIX go low, because everyone's sort of calm. Everything's going up. The bonds and equities, historically, they're supposed to not move in tandem, but they are moving more in tandem than they ever used to. Now, the thing I want to point out to people who are listening to this podcast are going, they might go, well, I invest in equities, I don't care about bonds, I'm a stock man. Then the problem is that in 2018 it looks like we might start seeing some inflation pick up. And if we do, because we see wage growth, which is the key to getting inflation go up, because if we start getting paid more, it then becomes a vicious circle that we start wanting to buy more goods and therefore want bigger pay rises, and it causes prices in the shops to go up. But one of the other big issues is that central banks around the world who have bought all these bonds are going to start thinking, well, we're trying to normalise interest rates and raise interest rates, which is bad for bonds, so people will start selling them and don't want them anymore. But also, all the bonds they've bought, they've got to do something with them. And so therefore they're going to start basically selling them or just letting them mature. But what it means is there's going to be one of the biggest buyers in the market for bonds and treasuries and gilts and things will disappear. And if that happens, then it means that the demand drops even further. And if people remember their sort of economics 101, if demand drops for something, the price drops. And therefore that means that the outlook for bonds could be pretty negative. Now, of course, people have been calling the end of the 30-year bond rally for years. Every year we seem to talk about it, and it never happens. So I wouldn't place too much emphasis on the idea that it will definitely happen. But things are starting to move to make it look likely that, the headwinds are definitely there. Now, the reason this matters for stock markets is if you get a sustained, it's normally if you get a big jump. So people suddenly go, oh my God, I've got to head for the exit on bonds. Now, because of the way the market has been, where people have been buying them en masse, and central banks in particular, that when they all head for the exit, it's like if there's a fire and everyone runs for the exit, and there's a very narrow exit, they all suddenly get stuck and can't get out. That's what would happen in a bond market at the moment. And people have become worried about this idea that there is going to be a problem, because who's going to buy them? And so if that happens, you could get the point where the price drops a lot. And when the price drops, the yield goes up. It's just the way they're priced. They move in opposite directions. And if that happens, then it starts to make stock investors nervous. And partly because if you invest in the stock market, it's they don't like when other markets have wobbles generally. But if you think about it, if bonds are meant to be fairly safe investments, and it's some analogy I've used before, it's like being in a skyscraper and the ground shakes, there's an earthquake, then I wouldn't want to be at the top of the skyscraper, which is equity markets, and we're using bonds as the ground in that analogy. Then that's what happens. But it is also because if bond markets have a wobble, it has the knock-on effect that when the price drops, the yield goes up. Then it also means the rates in the yields and the interest rates in the economy tend to go up. And it means that the cost of borrowing for everybody goes up, whether it's mortgages or for companies. And if that happens, then that makes the economy, it's a headwind for the economy, obviously. And therefore the economy might start to stutter. And if that happens and people spend less because their mortgages are going up, then it means that company profits might go down. So I know I've chucked in a lot in there, but it's just to show you the way the thought processes work and the supposed logic works, that a bond wobble in 2018 is the one thing that people are probably might want to keep an eye on, and because it could precede a stock market crash. And there's been many instances in the past where a big wobble in the stock market, the bond market, has preceded one in the bond market. Let me start that again, Andy. A wobble in the bond market has preceded a fall in the stock market. And we've seen tiny elements of this in the last few months. There was one just before Christmas. We had the bond market chuck a wobbler, and the stock market rally took a pause and dipped. And we've seen a bit of it again this year. And so I write extensively about that in actually this week's 80/20 newsletter. If people are interested, you can get a free trial. I'm not just plugging 80/20 all the time. It's just if you are intrigued, then you can go and find out a bit more about what to look for and some indicators to look at that might start to show you if bond markets are starting to go south. So that is the outlook for 2018, we're at market highs. If you keep setting market highs in stock markets, it isn't a sign of a downtrend. It's actually a sign of an uptrend, and it doesn't mean it's going to keep going. But until you see those, we see that it start to turn over and we see lower lows, then that's when you've got to start probably running for the hills if it happens. But these other markets, the volatility index, the VIX, and bond markets are going to be key in, I think, 2018. We see some stress in those areas, then maybe the stock markets will start to show stress too.
Good stuff, Damien. Okay, so we're going on to pensions next.
Yeah, I mean, this is ways to boost your pension. As a quick aside before I jump onto that whole idea about people buying bonds and central banks buying bonds is actually quite interesting, even if you're not into investing. And it's one of the reasons why basically China has become America's bank manager. And if you want me to elaborate on that, then tweet me and I can talk about it next week. But despite Donald Trump having a pop at China, China is the US's bank manager. So it's a bit like you having a pop at your bank manager, and then they can put your interest rate up in your own economy. So if you want to know what I'm whittling on about there, then I can talk about it. It's quite an interesting bit of economics that people don't understand. But yes, Andy, I talk about pensions. Now, everybody gets a New Year's resolution normally and they think, I must start saving for retirement. So the first thing I want to do is, if that is you and you've not done it yet, go to this web address, which is one of our own. It's calculators.moneytothemasses.com/pension. And that's a pension calculator we spent a lot of time and money on, which will project your potential pension pot. If you have one, even if you don't, you can put in your employer contributions, your current contributions, the contributions you'd like to make, and it will tell you how much you are likely to have as a pot in retirement and what that might be in retirement income. And it also tells you how far you are away from your potential target based on how much you earn now. Now, it's a really neat tool, I would say that, but it works well on mobile. So if you're there, then go to that web address, calculators.moneytothemasses.com/pension, and it's free to use. Now, going on to the wider pension thing, I'm conscious of the time, so I'm going to jump through them. Now, what I want people to do is a bit of a that tool will help you in a pension DIY really, and give you some realistic information. Now, if you're thinking, what am I doing about my pension, and what should I, where am I? And then, so one of the first things you could do is check what your state pension might be. Now, people might not realise that your state pension is based on your national insurance contribution record. So if you're heading and you're nearing retirement, then you can go online on the .gov website and get a free state pension forecast. Now, it used to be you couldn't do it until you were within a certain period of time of your retirement age. It seems to, when I've been checking this, I can't see any reference to that anymore. So if you go on there, then you can try and get a forecast, and presumably you'll be able to. If you can't, then you have to wait for a later date. One of the things I do want to chuck out there, though, to people now, what it should be is that it's become easier to get these state pension forecasts, so you can see how much pension you are likely to get when you retire. But the problem is that there's been some news lately to say that the state pension forecasts have been incorrect, which is slightly frustrating, to be honest. But what's happened is, if you've ever contracted out, so if you were ever in typically a final salary pension scheme, you probably did contract out, then it doesn't forecast those years very well. It messes up your entitlement slightly. So if that is you, then ring them up when you get your forecast and they can double check what's gone on. But there's been some people getting incorrect forecasts. The other thing to go on and do is to ponder maxing out your employer contributions. Now, because of auto-enrolment, employers have to pay a certain amount into your pension when they provide you a pension scheme. Now, make sure they are paying that, and therefore maximise those. And if you're in a pension scheme whereby they will match your contributions, then try and pay in as much as you can, because it's effectively free money. The next point I would say is, if you are in a pension scheme which you can choose the funds that you are in, if it's a SIP that's your own or a company scheme, then make sure you review the funds themselves, because there's no point sitting in a dud fund forever. That is a typical thing that happens. People go into a default fund that is picked, and a default fund will have probably low charges. Doesn't always, if it's an historic old type of contract, but you want to maximise your return, so make sure you review them, and if you need to, then you may look into moving your pension and transferring, but obviously you need to take advice on that in order to have more investment choice. Now, if you want to maximise your contributions, it is possible on a state pension to fill the gaps that you have. You don't have to just accept the fact that you didn't pay national insurance contributions maybe for whatever reason at a period of time. You can fill some of those gaps with class 3 national insurance contributions. So you can find out that information from the .gov website, and then you can speak to the relevant people about doing that. You can also carry forward, if you're fortunate enough to be able to pay the maximum amount of pension every year, so it's typically around £40,000, but it's dependent on how much you earn, then you may max out because you're suddenly panicking to fill up your pension and you're slightly older. You can carry forward unused annual allowances from previous years. So we have some information of that on the Money to the Masses website. So don't think you're just stuck with the maximum amount this year. You can kind of bring back some of the old allowances that you haven't used and therefore top up your pension. There are rules around that, but which we explain on the site. The other thing to ponder is if you have a whole bunch of pensions, or you had a whole bunch of employers and you don't know if you ever had a pension with them, there is the pension tracing service out there which is free, which you can go on there and you can put in information and find out details of past trustees or schemes which you can then get in touch with and therefore find out about lost pensions. I've known people who've done this who found pension pots with tens of thousands of pounds in they'd forgotten about because it grows over time. Now the other thing to do, you could therefore consolidate those to try and again cut costs or increase investment choice and make it easier to manage. Cutting costs is obviously a general thing anyway. If you reduce the charges you're paying over the longer term, it has a ridiculous impact on the eventual pot you have. The pension calculator that I talked about earlier, if you use that, you can go into the advanced settings and start changing the assumed charges to see the impact on your pension pot. So go on there, even if you don't want to do a projection as such, and put in your pension details, and you can see, well, if I reduce my charges from say 1.5% to 0.5%, the impact it could have over say 20 years compounded, and that gives you an incentive to try and reduce your charges. The other thing is, if you do decide to buy an annuity, you're getting near retirement. Of course, there's drawdown where you can take an income but leave your money invested. And some people don't like the idea of annuities, where you give your pension pot over to, say, an insurance company, and they take your money, say thank you very much, and then give you a guaranteed income for the rest of your life until you die. You can get better value ones by something called enhanced annuities, which take into account the fact that you might have poor health. Effectively, you're more likely to die statistically, so they give you a better income level. But it's the one time in life where having a poor medical history can be a benefit, assuming that you do live longer than you're expected to. So look out for enhanced annuities. There aren't so many of them out there, but there are people who do them. People like Hargreaves have always had an enhanced annuity comparison service if you want to have a look at it. So they are just some of the things you could do to try and boost your pension. And if you do use that calculator I mentioned earlier, you will actually end up being invited to have a free pension check, which is something run by a company called Vouched For, which is a company that basically reviews of financial advisors, etc. And what they've done is they've managed to get advisors to do a free pension check for people. It's a way of obviously engaging people with financial advisors, but it also is a way of giving people some basic advice or information ahead of them deciding they might want to seek formal financial advice. So there you go, Andy. It was an action-packed podcast there. I hope I haven't blown anybody's brain, but or sent them to sleep.
No, I'm sure you haven't, my friend. It was enjoyable, and I like the fact that we started with potentially the negatives in terms of what's going on in the press, and we finished it with loads of positive stuff about people checking pensions and making money and investing and all that kind of stuff. So yeah, power to you. If you want to get in touch with Damien did mention at the start how to do that, but again, it is Damien at moneytothemasses.com, or on Twitter it is at moneytothemasses with the number 2. As always, if you could, and if you like the show and you want to hear more from us and you want to support the show, the best way of doing that is going online, going onto iTunes or your podcast provider and popping a little review on there. 5 stars, please. It really does help. It helps to sort of spread the word with the rest of the people. It means we can reach more listeners and help more people.
Final thing, if you are one of those people who were a pensioner and you had a pensioner bond, which is maturing, there was something that was created by the NS&I National Savings and Investments, basically institute, the government-backed entity. Some of them are maturing now. They were paying epic levels of interest, about 4%, and some of them are maturing around about now. People are wondering what to do with that money, whether they should go into the new style contracts which pay much lower interest rates, or shop around. Then if you go on our Facebook page, there was an article that was in one of the national newspapers which I provided some input, including some investment ideas on there. So go and have a look at that.
Good. We're done. Until next week.
Until next week, Andy. Goodbye.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.